The world woke up on Friday to a wave of green screens, global stock markets rising together in a way that looked almost unnatural. Japan's Nikkei blasting past 50,000, Hong Kong's Hang Seng surging like it hadn't in years, and Europe opening strong as if every trader suddenly agreed that the future was bright. On the surface, it looked like confidence. In reality, something far more unsettling was moving beneath the charts. The rally didn't begin in Asia. It started the night before, across the ocean in the United States, where Wall Street had just pushed the S&P 500 and the Dow Jones to brand new all-time highs. The Dow jumped more than 600 points in a single session, almost violent for an index of that size. Traders were cheering, commentators were celebrating, and analysts were calling it the beginning of a new bull market. But if you listen closely, the excitement sounded forced, like people pretending they weren't terrified of what was actually happening. Because here's the part the headline skipped. The rally wasn't built on companies performing better. It wasn't built on real earnings, innovation, or genuine economic strength. It was built on fear of missing out, fear of falling behind, and fear that if investors didn't jump in now, they would be left holding nothing while everyone else got rich. Everything started earlier in the week, when the US Federal Reserve cut interest rates again. It was the third cut of the year, a clear sign that the economy wasn't as healthy as politicians wanted people to believe. Normally, a rate cut is a warning, but modern markets don't behave normally anymore. Instead of panicking, investors rushed in like adrenaline addicts finally handed their next hit. Cheaper money meant higher stock prices, even if the underlying companies weren't actually improving. As soon as the Fed cut the rate, the rotation started. Money poured out of shaky tech stocks, especially AI companies that had been hyped beyond logic, and flowed straight into banks, financials, and old-school cyclical industries. Goldman Sachs and Morgan shot up more than 2%. Visa exploded over 6% after a ratings upgrade. Traders knew exactly what they were doing, moving to sectors that benefit the most from cheap credit before the window closes.
But while the media showed smiling traders ringing bells, Silicon Valley was quietly panicking. Rumors of an AI bubble had been floating around for months, but this time the fear was visible. Nvidia, Oracle, and other giants saw violent swings as investors questioned whether the AI revolution had real profit behind it or whether everyone had simply convinced themselves it did. Billions of dollars in market capitalization evaporated in minutes, but no one talked about it because bad news doesn't trend when the charts are green. That's where the story turns darker because the rally wasn't a sign of strength, it was a sign of imbalance. Money wasn't flowing because the world economy was improving. It was flowing because central banks were trying to keep the system from cracking, and investors were reacting like gamblers sensing the casino might shut down. In Tokyo, traders were celebrating the Nikkei's massive jump to 50,836 points. But behind that number was a quiet desperation. Japan's economy had been struggling with weak spending, low wages, and population decline. The only thing pushing markets higher was foreign money chasing easy gains in a country where interest rates had been near zero for decades. Investors weren't betting on Japan. They were betting on momentum, and momentum is the most dangerous force in finance because it snaps without warning. Over in Hong Kong, the Hang Seng surged nearly to %, a rise big enough to be called a victory after years of decline. But deep inside the Chinese markets, there was anxiety. Property developers were drowning, local governments were buried in debt, and consumer confidence was weak. Yet the markets still climbed because traders weren't buying China. They were buying whatever looked like it might move next. Europe wasn't any different. The Euro Stoxx 50 opened higher, boosted by the same simple logic. If America is pumping, the rest of the world will follow. Investors weren't looking at manufacturing data, inflation numbers, or the energy crisis. They were looking at Wall Street and copying its behavior, hoping the wave wouldn't collapse before it reached them. But the question hanging over the entire day was simple: how long can a rally built on fear and cheap money actually last? As markets surged, analysts kept repeating the same phrase: soft landing. The idea that central banks could slow down inflation without causing a recession sounded great, but history showed otherwise. Every major rate cut cycle in the last 50 years happened right before economic pain, not after. But instead of acknowledging the risk, investors ran straight into the fire, convinced this time would be different. It never is. Meanwhile, inside trading floors from New York to Singapore, something uncomfortable was happening. Traders weren't celebrating. They were watching, observing, waiting. They knew rallies like this don't end quietly. They explode, either upward into a true bull market or downward into a correction that wipes out months of gains in hours. And with tech stocks wobbling, geopolitical tensions rising, and central banks running out of ammunition, the wrong kind of explosion felt more likely. By the time the day ended, the headlines were glowing, stocks surge worldwide, Wall Street hits new highs, investors celebrate market comeback. But behind those headlines was a truth most people didn't want to face. The system wasn't stabilizing. It was stretching, inflating, losing touch with reality inch by inch. For ordinary people watching the markets from the outside, it all looked simple. Green means good, red means bad. But that's not how financial systems work. Sometimes green means danger. Sometimes green means the foundations are cracking but the paint on the surface still looks fresh. Sometimes green is the color of calm before collapse. This was one of those moments. The world wasn't witnessing the beginning of a new golden age. It was witnessing a pressure build up, one that could reward the fearless, ruin the reckless, and expose anyone who thought markets only move in one direction. Whatever comes next won't be subtle. Markets driven by emotion don't cool down slowly. They snap. And when they do, the same headlines celebrating the rally will turn into the same headlines wondering how no one saw the warning signs. You're seeing them right now.